Hi, John. Thank you very much for joining us today. How are things in the great state of Colorado?
They're great. Weather is very acceptable for my standards, and I'll probably play golf this afternoon. So all is good.
Yeah, I have to admit, Colorado is one of my favorite states. I love it in the wintertime and I love it in the summertime. Beautiful
But,
place.
yeah, just avoid it during mud season, which we've just gotten through.
So, John, you have been investing in gold and gold equities for many years now, and I want to get your views on that sector. But before we do so, I want to start with the economy. And I want to get your views on the economy and where it's going. This time last year, we had the economy was going at 3% growth. In Q1 of this year, it came in at 1.6%. Then it was revised down to 1.3%. Where do you think we're heading now that we're at the end of Q2? Do you think we're approaching zero growth or maybe negative growth?
Yeah, I think what I would start with is that the investment consensus is positioned for a soft landing. And I would question that. I think the evidence is mounting that we're going to have a downturn that nobody, including the Fed, expects. And what can we point to? We could point to the rise in unemployment. The last two non-farm payrolls, we've seen an increase in unemployment, and I think we're now at 4%. We can point to weaker retail sales, and we can point to what I kind of get stuck on is the fact that the non-farm payroll survey, most of the job creation is in part-time jobs. It's in government, education, but they're not economic jobs. And lastly on that is that they're theoretical. It's not like somebody goes out and knocks on the door of a household or a business and says, what's the job picture? They have this birth-death ratio, which is a formula, theoretical, and so that job creation has exceeded and mostly explain the so-called job growth that we've seen over the last, let's say, 12 months. I don't have the exact numbers, but it's been a huge number. But if you look at the household survey, where they actually go out and knock on doors and they ask a family, what's going on, it diverges dramatically. And there are some, and you mentioned one name, Lacey Hunt, who's a highly respected economist and bond bull, that there will be substantial downward revisions, maybe later this summer, and I think he told me recently, early next year, that will move in the direction of the household survey, and that job creation that everyone believes has been taking place just isn't there. So that's maybe too much on jobs, but it's one of the big things where, and I would again say, the numbers come out of the Bureau of Labor Statistics, which is under the administration, and we're in election year, and wouldn't it be strange if they weren't fudging the numbers to make them look better for the incumbent administration? Now, I don't want to sound like tinfoil hat, but I just think that so much of the evidence suggests to me that the economic consensus is that Powell's going to stick a soft landing, and I'd take the under on that. I would say he's not going to. They're going to have egg on their face. They're going to have to hit the retro rockets on this so-called monetary stringency, and we're going to go into a rate cutting cycle at warp speed, probably in the next 6 months, and that will be probably very helpful for precious metals, and hopefully mining stocks as well.
So I just want to summarize a few of the comments that you just made. You don't think we're going to hit a soft landing. It sounds like you think it's going to be a lot more aggressive, and the economy could be or will be going into a recession. Do I have that right?
Yes. Yeah, I think we'll have a recession. By the way, if there is a recession, and this is my take on what I'm seeing, and I can be as right or wrong as anyone, but I do think, as I said, the evidence is starting to mount in favor of a much weaker economy than the consensus expects. There are a lot of except call it rot under the surface, and a couple of things. One is regional banks are heavily invested in commercial real estate. Commercial real estate, we know, is a problem area. For a lot of different reasons, but the big one that most people would understand is that more and more people don't want to go to the office every day and don't need to, good and bad. The other domino that I think would be exposed big time in a recession is private equity, which is thought to be an alternative asset class. But all they're doing, I think these days, maybe at one time it was a very good idea, and businesses were better managed under the guise of a private equity group. But now so much money is flowing in, they're buying car washes and golf, driving ranges, and the multiples are ridiculous. And I read the other day that the Blackstone REIT does not submit valuations to outside appraisers, and they are getting calls for redemption, and they are basically funding those redemption requests with new money coming in. So that's the definition of a Ponzi scheme. Again, not my area of expertise, just stuff I've read, just anecdotal, but I think those two things, regional banks and private equity, could be exposed big time if the economy slips into a recession. And, is a global financial crisis worthy? Everyone says, who I've read about it, said, well, it's not systemic. When you hear that, you say, well, it is systemic. It could be. So are we headed to another episode like 2007, 2008? Who knows? But I think it's more likely than not that there's a lot of downside to the economic outlook. And this gets me to, I'm not even giving you a chance to ask questions, but it's just one of the things that I think is missing for gold mining stocks is the comfort level that mainstream investors have with how they're positioned. And they're positioned, how are they positioned? They're positioned in, all things AI. They're positioned in a very few stocks that explain the movement of the S&P. And so it's a very crowded trade. I think if that crowded trade starts to unwind, people will look around and say, well, what else is there? And they will discover, in my opinion, they will discover the opportunities in precious metals mining stocks, which we can talk about, as we go along here. But that to me is the setup that I see for gold mining stocks and also for precious metals.
Yes, you raised some interesting comments about private equity and also private credit, and very reminiscent of 08, 09, when you had these mortgages, they were being valued by third-party valuation firms, and the same sort of things going on with these private equity funds.
Right.
So the values that are being placed on them are not the true values. They could be significantly lower.
Right. There needs to be price discovery, and I think you'll get that in an economic downturn.
So you made mention of the fact that you think the economy is slowing down and possibly going into a recession or in a recession. And I want to bring up the Fed. In 2021, the Fed made a serious policy error by saying that inflation was transitory. And then by March of 2022, they woke up to the fact that, oh my God, it's not. We got a serious problem here. We got to contain it. And then they lifted interest rates 11 times over the ensuing 16 months. Okay. Do you think the Fed is making another policy error right now by not cutting rates faster?
The short answer is yes. I think they will be forced to become very aggressive in terms of monetary ease. Again, hit the retro rockets from where they're standing. I think they will be as surprised as the rest of the world that they've been restrictive too long. I remember I heard Tom Hainig, who was one of the members of the FOMC for many, many years from Kansas City, and he said he was the one dissenter over many years on the zero interest rate policy. And I met him a few years ago at a conference, and he said, deals that were done, financings that were done in a zero interest rate environment cannot survive a 5% interest rate environment. So the longer we are at 5%, let's say, the more damage there will be, because as you hit this wall of refinancings, which is another thing to talk about, the carry that was once very achievable at 0% or 1% or 2% is no longer makes sense. So the credit problems that could arise for the Fed overstaying this restrictive monetary stance would again contribute, in my opinion, to a deeper and more protracted recession than what anybody is expecting.
So the scenario that you are painting is very bullish for gold. Okay. So we got a slowing economy, and because the Fed is behind the curve, they're going to be forced to cut interest rates drastically. That's going to result in a lower US dollar and a higher price of gold. So let's look at the price of gold right now. It's trading at or near all-time highs. I believe it's up somewhere between 10 to 15% on the year, but the equities, we're not seeing, the equities are not participating in this move at all. They're trading at a big discount. Why do you think that is?
I think there are a couple reasons. One is that I don't think the average investor is paying any attention because they're very comfortable in their current investment program, which again, as I said earlier, is heavily weighted towards things that sort of approach the definition of a bubble. And so while there's been some recognition that the gold price is in record territory, the connection between what that means for earnings and cash flow of mining companies is just pretty much of an academic exercise and of little interest, as long as there's a comfort level with current investment positioning. So we have mining companies that are trading at historically cheap discounts to NAV. Big disconnect, not so much this year, but over the last 5 years, let's say, of the relationship of gold mining stocks to the gold price. So I think there's a huge mean reversion trade ahead of us, assuming gold prices stay at these levels, and then I could make an argument for why they could still even move higher. If and when people lose their degree of comfort and complacency with how they're currently positioned. I think that lies ahead, and that's why I would say We are at the cusp of a big move in mining stocks, even if the gold price stays where it is. I don't think that's going to be the case.
So one of the reasons why gold is trading at or near all-time highs is because of central banks around the world have been massive buyers. And in the last couple of years, I believe in 2022 and 2023, they acquired approximately 25% of all annual production according to the World Gold Council. And my question to you is, do you think because of this central bank buying that the central banks are creating like an artificial price in the price of gold? And in other words, if they weren't buying, the price of gold would be a lot lower. And maybe the equities are factoring in the real price of gold, which could be $1,600 to $1,800, depending on what names you look at.
Right. No, I think that's right. I mean, I think that, again, the reason central banks have been buying, is that we're seeing a shift in the way trade is taking place, particularly in the BRIC nations, the BRIC part of the world, that's China, Russia, Brazil, a lot of the emerging market economies, are trading among themselves, and they are not recycling trade surpluses into U.S. treasuries. They are recycling, first of all, the way the trade is taking place is that Saudi Arabia sells China oil. China pays in RMB, their currency. And the Saudis are now accepting Chinese currency, whereas before the Chinese would have had to acquire US dollars to pay for the oil. That's no longer taking place. And so so how does that work? What that means is that Saudis are accepting Chinese currency. China's starting to sell things to the Saudi Arabia that the Saudis pay for with the RMB that they've accumulated. And at the end of the day, maybe there's a trade surplus on the Saudi side, which was always used to be the case. And they would take that surplus and they would invest it in U.S. treasuries. And they would collect interest and then, that was the way it was done. What they're doing now is they are asking the Chinese to settle up the surplus in gold. So that's the utility of gold for the BRIC countries. It's not happening for the U.S., it's not happening for Europe, but it's happening in the BRIC part of the world, which is about a third, I think, more than a third of the global landmass and probably a third of the global GDP. So a lot of trade is taking place that way. I think 20% of energy is now traded away from the US dollar. So that's why central banks have been buying gold to recycle trade surplus, to settle trade deficits, surpluses with gold which is a neutral reserve asset, as opposed to U.S. dollars. That has implications down the road, which may not become apparent for a few years. But here we are issuing, the U.S., record amounts of U.S. treasuries because of the deficits we have. And the pool of capital that used to find U.S. treasuries useful because they could recycle trade surpluses into them is not doing that anymore. So we have supply of U.S. treasuries going up and demand outside the U.S. going down. And what that tells me, that is potentially a serious issue for credit markets, bond markets in particular, sovereign bond markets, at some point over the next, let's say, 2-3 years. So getting back to your original question, no, I don't think central bank buying, which is the big explanation for where the gold price is today at record highs, is a bubble. I think it's a reflection of reorientation of the global trading system, which has sustainable characteristics. It's not the algos in New York and London and Europe buying gold because it's going up and just piling into it, an unsustainable scenario. It's for reasons that gold is thought to be more useful and preferable than U.S. Treasuries to play a part in trade among a big part of the world.
John, you touched on debt levels, and so I got to bring this up and get your views on this. But we have these record debt levels in the U.S. Federal debt's around $35 trillion. It's growing by $1 trillion every 100 days. These numbers are just mind-boggling when you think about it. Debt to GDP is around 125%. I believe that's at or close to an all-time record. But what are your thoughts on these debt levels? How do you think it gets resolved, and what does this ultimately mean for the gold price?
Well, there's some very smart economists who would take a different view than what a lot of people are saying about debt levels. They would say that, debt levels are high, but if the economy can grow, we can service the debt. But for that to be right, we have to have a growing economy. Where that argument falls apart is if we have an economic slowdown, because that makes it harder to service the debt. It also means that there will be more debt issued because you issue more debt in a recession. And so those are two opposing points of view on the issue that you just brought up. I would be of the school that would say, debt, I can understand the argument that debt levels are okay if we have a strong economy, that we're growing, and we can service the debt. But if the economy weakens, then that's a different story. And that creates, again, against what I said earlier, with foreign countries finding U.S. debt less and less useful to recycle trade surpluses. You've got a question on price discovery, and that would say maybe the 4.25% 10-year isn't the right level for U.S. debt. Maybe it should be 6%. Maybe it should be 7% if we have proper price discovery. And if that were to be right, think about what that would mean. The Fed is irrelevant. What it would mean is that, no matter what Powell thinks or says or does, it doesn't matter, because we don't have a viable long-term debt market, and everything will need to be financed on the short end. And they're already doing that. They're already shortening maturities because when they've tried to do these 7 to 10-year and maybe 30-year auctions, they have basically laid an egg. And so where we are today is that we're more and more forced into what you would think of as a banana republic, where we're financing everything on the short end. And that's the easiest part of the yield curve to control. And again, I think the gold market would see through that, and it would be very, very positive for the gold price.
John, there is a lot of economic uncertainty in the world right now. We have geopolitical risk over the Middle East and also the Ukraine. Within the U.S., we have a slowing economy. We have record high debt levels. We still have sticky inflation. We have an election coming up. What are you suggesting to investors? How do they position themselves in this current environment?
Well, I would suggest that they reposition themselves more in the direction of gold and related mining stocks. I have a chart which I'm just citing from memory that the exposure to gold, and that would be gold and mining stocks, is the lowest it's been in 5 years among financial advisors in the United States. And so I would just say to think about that. And in the context, if you were to agree with some of the things I've said, why wouldn't you re-weight your exposure to gold, which is almost nothing? Maybe re-weight it from 1%, which is about what it is, to maybe 2 or 3%. And I think people will do that if the economy falters the way I think it will. They'll be forced to do it, to rethink it, because the investment positioning that they have now will not be working, and their clients will be asking them, what else should we be doing? So I think that's the sort of sequence that I would see for gold to move higher from where it is today, maybe 15, 20%. It's not crazy in my mind to think about $3,000 gold if we do have a recession. And if we have $3,000 gold, what does that mean for earnings of mining stocks that are already, as we've talked about, disconnected historically from the usual relationship in terms of valuation to the gold price? So that, to me, that means that many gold mining stocks, which to me are still depressed relative to their earnings power and relative to where the current gold price is, have significant upside over the next 12 months. And so I'm not sure that I'll have a lot of people listening to me right now, but that's what I think they should do. And that's what I think they will do if we head into a recession.
Well, John, that was a fascinating discussion, and I want to thank you very much for spending time with us today. You and your team are prolific writers on all things gold. If somebody would like to read some of your reports, where can they go?
Go to the Sprott website, which is Sprott.com. But we have a tremendous flow of information, not just from me, but from many other of our portfolio managers and analysts that I think investors who might want to check out this line of reasoning would find very helpful.
Well, once again, John, thank you, and I look forward to our next conversation.
Thanks a lot. Enjoyed it.